All right, we are live and back for the Mr. Rent to Own Home Show. My name is Dominic Danino, aka Mr. Rent to Own Homes, and in this episode, we're going to be talking about what are the benefits of our rent to own program to buyers. So, as usual, I am joined by my partner James Brown, real estate investor, real estate agent from Colorado. So, welcome back, James. How you doing, buddy?
You. I'm doing good.
President
wow.
accountant, right?
I used to work with a gal that would correct English, and I do that too. She was always like, "You're well, you're not good." I'm like, it's stuck in my head.
Yeah, the English teachers, right?
Yeah.
All right, let's get to it, right? So the topic of the day is what are the benefits? And so this sort of came about over the last couple of days, talking to a couple people, speaking to an agent, right? So I had an agent that kind of had a client that potentially would be, a rent-to-own home buyer, basically. And obviously he has some questions initially when people are kind of getting new to this, kind of have to go through the process of explaining to him how it works and so forth, right? So after we kind of went over that, he was totally on board. He understood it. He's like, oh, yeah, this is great. This is great for somebody, especially for this particular client that's in this situation that they can't qualify for. Maybe we dive deep into a few of the reasons why they can't, right? So, but anyway, so I think it's important for us to reemphasize, because from time to time we hear somebody that doesn't understand it, or we haven't had a conversation, and initially they see it and they're like, well, why would somebody want to do that, right? So, so you wanna start there and kind of So if an other agent or a lender or a potential buyer says, well, why would somebody want to do this? What do you say?
Yeah, well, I think you're on the right track there. Like, let's start about like why they're gonna do it, why they need to, and then also then we'll layer in why they'd want to, right? So why they need to, typically, and you're a lender, so you see this all the time, like, and they've got check boxes as a lender, you as a broker, depending on lenders, have an extra layer, like above and beyond, like all the check boxes FHA requires, as an example. You might have what do you call those?
Overlays. Yeah, overlays.
Thank you.
Lender overlays.
Exactly. So if somebody doesn't check all the boxes, they have no other choice. They're not going to be able to buy a house, right? So that's the basic thing. So why they can't qualify, there's multiple reasons. Usually people think, oh, it's bad credit. And it's not always. Ideally, they don't have any credit issues, right? Typically, what's a best fit is somebody that's self-employed. They need a full 2 years taxes and income to be able to qualify. So, and there's a lot of self-employed people these days, right? It's becoming more common. And so there's more people that can't buy houses because banks don't like self-employed people as much as stable W-2 employees. So
yeah, so our economy has changed, right? We're not in the 50s anymore, where the way that people used to get paid was, hey, they punch in, punch out, they go to a factory, work 40 hours a week, work on the assembly line. And that's basically a lot of mortgage programs came out of that period. And that's really hasn't evolved a whole ton, right? There's some newer stuff out there, but generally, like the government-backed stuff, they are looking for predictability, stability, right? So they are as risk adverse as they can possibly be, right? But so they're not geared for somebody when they're self-employed, they have their own business. They have fluctuations in income, right? There's not a steady, right? If you're running a business and you're selling cookies or you got a bakery, right? Your revenue for 1 week or for 1 month may vary from month to month based on seasonality, based on various factors. based on your location. So there's not there's no predictable way of knowing exactly month to month. So when it comes to lending, they look at overall average, right? So they'll take either a 12-month or a 24-month period to kind of average out what your average is per month. Well, there are fluctuations with that. So let's say you had a killer year last year, and this year's not as bad. I mean, not as good, but it's not bad. Well, the lenders won't average out the good year with the lower year. They'll take the lower of, right? So now that keeps somebody from qualifying, where if you took the average, then technically they would qualify for more, right? So there are these little quirks involved when somebody doesn't have a predictable W-2 hourly rate, 40 hours a week, that kind of keep people from getting qualified, right? The other thing is, being an entrepreneur, even if you got an MBA in business administration, right? They don't really teach you the skills to be a business owner. You end up having to learn as you go, right? So I'll give you an example. So this particular client, the situation is they don't have a 10-year history of business. They're only about 28 months in, right? So a little bit over 2 years. However, they're doing well, but along the way, nobody coached them and said, hey, you know what? Out of all this income that you got to do, you got to set some of that aside because you're going to have to pay taxes. Well, they didn't do that, right? So when tax time comes, they owe taxes. They owe the IRS taxes. They owe the state taxes, right? And so that shows up on your credit report. You have a tax lien. It's called a tax lien. That thing doesn't go away. Tax liens, if you file for bankruptcy, do not go away.
Right.
You can't discharge those things, even if you wanted to.
Uncle Sam wants his money.
They want their money, right? The government's going to get their money. So nobody coached them along the way to say, hey, you should have done this. And so they don't end up finding out until a year or two, because the first year they're happy that they're business. They're busy. They're not, they didn't get coached because nobody at the beginning said, hey, you must do this stuff, or they didn't get locked in with a CPA. Usually if people start a business or a side hustle, hey, let me just start and kind of see what happens and things get going, but they're not thinking of these things. And then tax time comes along, and I was like, oh, why nobody tell me I owe taxes on it? Well, it ain't free money, right? Yep. You got to pay your part. So anyways, so this is what happens.
Yeah, that's common.
Right? These kind of things. Nothing wrong with the individual. They're not deadbeats, as most of the time people think, oh, well, it's got to be just quote unquote deadbeats or people that are not financially savvy or bad credit and so forth, right? Now it could be bad credit too, but so there are multiple things that come along with people that are in business for themselves that learn as you go. Right. So he learned a lesson. I was like, oh man, I got to just start setting money aside. Right. So, and now I'm behind, and I don't want to take that money out of me running my business. I can only pay it in part. So then working through that process so that they can get right with their taxes. So that way they can qualify down the road. But in the meantime, doesn't mean they're going to stop doing business. And doesn't mean they don't, in the meantime, they want to own a home instead of currently renting. Right. So they want to move into something that, hey, I want to make this my permanent residence, or I want to call this home. I want to have something to come back into. This is why I work so hard for, right? So our rent-to-own home programs gives them that opportunity to kind of start the path to home ownership, basically, right? So we're just a bridge for a period of time until they can get mortgage ready, as we call it, right? So that way they can go get their financing. It could be a year, 2, 3, 4, 5, potentially, right? So that's an example of why somebody that's self-employed would do this, because, hey, if they wait in a year or 2 or 3 or 4, when they've gotten all of that fixed up, the property that they think they want today isn't going to be there. Right.
No. And it might cost more. Right.
Absolutely. Right. So if you wait 3 or 5 years, houses and prices are going to continue going up. We talked in a couple of episodes back as to the impacts of what's happened with the California wildfires that could have an impact on the housing market for West Coast states, right? Where, hey, it's going to be additional shortage, material, lumber, windows, cabinets, all of that's going to go up because there's going to be demand to rebuild over there. And it's going to suck up some of that material from areas next states next to California, right? Labor as well, right? So those people that are going to do the work and put up the houses, right? They're coming from somewhere. It may not, they're going to need additional workforce that come from other places. And so that's going to drive up costs, right? Labor costs are going to be a factor, right? So you wait for all of that to happen. Things are going to get more expensive, right? So
we've got limited inventory, right? So
absolutely,
for many reasons for that, right?
Yeah.
If I can jump in here.
Yeah, of course.
Let me go back to another need, a reason why people need to do this, and then use a story for a want. So things you and I hear every day is, oh, I'm a self-employed business owner. I'm doing like all of us that are self-employed. I'm writing off as much as I legally can and not claiming as much income, but a bank wants to see the opposite of that. So we see that all the time. So they've got to kind of go, okay, well.
It's twofold, right? Because we've been pre-programmed, or we hear this, that, the other. Hey, pay the least amount of taxes legally, right? So basically, there are, for self-employed or business owners, there are tax benefits. Benefits being, hey, you're able to expense a lot of it. You're able to write off a lot of expenses to run a business, because the intent of the business is to generate more revenue, right? So the IRS code gives you benefits to that, right? You're generating revenue and hopefully you're creating jobs, right? That's the whole premise behind that, right? So people are taught that too. Their tax preparers, their CPAs, or whomever's counseling them or doing their taxes encourages that and is looking for those reasons so they can pay the least amount of taxes. But when it comes to getting money from a bank, that doesn't help you, right? Because the bank wants to see, well, you made $1 million, you wrote off $1 million. Well, what are you living on? How are you going to make this payment? It's like, well, they're paper losses, yes. But from a banking perspective, they're looking at, what are you netting? So you make $1 million and you write off $500,000, then great. You're left with $500,000 to live on and make this payment on this house that you want, right? Or this car, whatever that may be, right? But if you roll all of it, it's like, well, they look at you like, well, you're broke on paper, right? How are you going to make this payment? Or, so they want taxable income from it when it comes to being self-employed, and they use that to qualify you. So even though your revenue was $1 million in sales or whatever you did, but if you wrote off $1 million and your net is zero, then you basically have no income, no qualifiable income under the bank's eyes, right? And in their view, you are not bankable, as they say, or you're not mortgage eligible. So that's a problem. Now, for those that understand and are in the mortgage business or whatever, there are some programs that are more flexible, but I'm talking about like FHA conventional programs and VA programs. Anything that's backed by the government requires net verifiable income. There are other programs that are going to be more flexible. So we do a bank statement loan, but you're not going to get market rate, right? So if rates are at 7% on the non-conforming, we call non-conforming or non-QM, those programs that are flexible, that it'll just take your 1099, your 12-month average on your bank statement, you're not going to get, if market rates are 7, you're not going to get 7, right? Those are going to be 8.5, maybe 9. So they're going to be higher than market rent because you're not considered an A paper, right? So if you fall into the conforming box, then you're sort of A paper. But anything outside of that is non-conforming. So somebody's willing to lend you money, but they're looking at it, well, you're a higher risk than somebody that fits into the box. So we have to adjust our pricing according for that additional risk.
Exactly.
Right? So you're not going to get the best rate. You can still get it, but you're not going to get the best rate, right? So yes, those programs are available, and I know agents know this sometimes, and they know lenders, but the pricing is not the same. So could we do that as a plan B? Absolutely, right? So that's kind of the path that I take them down and say, hey, can you fit into box A, or are you a box B or C or D or whatever that may be? We just kind of follow that path. If we can get you into a conforming box A, you qualify FHA and conventional, then yeah, rent to own is not for you. You should be trying to do a traditional loan, and then look at if you don't fit into that, then that's a discussion with us having. It's like, hey, maybe we can get you into a box B or a box C, and rent to own is a plan, a backup plan, right? As a last resort, and say, hey, none of these boxes fit, because not only do you not have verifiable income from a tax returns, we're using banks, and on those programs, they also need credit, and they need high credit scores too. So if they need a 700 credit score and you can't qualify because of your tax returns, then now you're out of plan B also, right? So maybe your credit score is 680, you don't fit, right? So we start going down these paths, and then there are other things. Oh, my ratios are too high because I got child support too, right? So an additional barrier to entry, right? So so we kind of follow these paths to see what box we can fit you into, obviously giving you the benefit of the doubt in trying to get you into box A first, then B, then C, and D, and so forth. So you want to continue on and kind of go over additional benefits to a buyer?
Yeah, let's get more into like the want side of it. And I'll use this as an example. So had somebody come to me, they were moving from Arizona, where you are, I think New Mexico. It's all the same. Anyway, it was a job transfer to Colorado. Guy made good money. He worked for Lockheed. It was a job transfer. They had a second home, and they were late on a payment, and it just totally threw everything off when they were trying to get this next place. They were moving with 5 kids, 2 dogs, all their stuff, trying to find a rental that they liked that was in an area that they wanted to be in here in Colorado, which is difficult to find. And they didn't want to have to like get here, straighten out that stuff, and buy a year later. They want to just move in right away and not have to move twice and just deal with all that. So that's more of a want, but a very serious one for a good reason. So we run into things like that. Had another one. Sometimes we have people that own houses. Like we had a couple own a home here in Aurora, Colorado, wanted to move to a rural area where other rent-to-own companies wouldn't even touch that normally. And it was not easy for many reasons, but we got it done. But, they wanted to get out of the city. They're tired of it, move to where her elderly parents were so they could help take care of them. So, but they couldn't sell that house and go buy another one. But they had picked out a really cool, like a log home style one in this rural area that we bought. So it was a want, not a need necessarily, but a serious reason to want to do it, so.
Yeah, it fits people into what they need today, right? So when somebody says, well, why would somebody want to do that? Well, you're not in their situation, right? If you can wait or you can qualify. So you brought up the first example when they happen to make sounds to me like they made a late payment on their mortgage when they were looking to relocate. Well, when they go apply for a mortgage, right, that is one of those little overlays that people don't talk about. It's like you can't have a mortgage late or a rental late in the last 12 months when you were applying, right? So if they just did it 2 months ago, then they got to wait another 10 months before they can come back and apply. Yep. Well, if they already sold their house and they got to move, a lot of people just say, hey, I'm not going to move into an apartment. I got 4 kids or 5 kids or whatever. I just came from a 2,000 or 3,000 square foot house. What am I going to do in an apartment? I got to get into a house. Yeah. Right. So this kind of fits their need today. And then, okay, we get you in, and now let's deal with the waiting and fixing whatever that's keeping you from qualifying today.
Yeah. Yeah. And another good point is the intention is for them to buy it, right? They've moved into it. They've put some money down, got in it. They can fix it up however they want. Wife doesn't like the color of the kitchen. She can do whatever she wants. Add a deck on the back. Anything really goes. I mean, they have to run it by us, make sure it's not something crazy that's going to devalue the house, right? But they can make it their home, like become that homeowner, not renting where it's just a temporary thing, right?
Yeah, so we give them the opportunity to make it their own, as you say, right? Because their goal is to keep it and make it their house because they picked it out. It isn't one house or two houses that we have in inventory or three houses and say, hey, only choices are one of these three here, right?
Yeah.
With our program, they have the ability to pick the house that they want. Now, obviously, it has to be a house that they can also afford, right? So yes, they may want the $1 million house, but if they don't qualify, they're never going to qualify for $1 million house because they don't have that kind of income, right? And then obviously we wouldn't put them into that, right? It has to make sense that they can afford it because we don't want to put somebody in a bind that they can't afford it and then they're going to be out anyways, right? So, and then when it comes time to getting their own financing, well, if they could never afford the $1 million house, they weren't going to get a loan for $1 million. Then why would we even start putting them into that situation? They're going to be set up to fail. So that is the advantage of me being a lender and being able to kind of look ahead and see, okay, what are going to be some of the things that are going to come up when you go get your own financing? Let's address them now, or let's get that fixed because you're going to need that, right? And so obviously affordability or something that your income makes sense that is going to qualify down the road, then okay, then yes, you can afford it and you can pick out up to a certain amount, right? So we go through that process of qualifying them so that way we can make sure that, hey, you can afford it. You're going to be able to meet the lender's criteria when you go get your financing because we've checked on your income. Now, hopefully your income has gone up and then it makes it easier to qualify, sure, right? But at least we're doing our part to make sure we're setting them up to succeed by checking and make sure that they can afford. I know a lot of rental programs, they don't even bother checking. They don't even know what to look for, right? Because they don't do this, right? They don't do this. They're just saying, hey, we'll take your money. If you pay, you pay. If you don't pay, we'll boot you out. We'll keep the money. And then good luck, right? If you get it done, if you get to the finish line, great. If not, that's even better for them, right? That's not how we operate. We want you to get to the finish line. We have a vested interest in you getting to the finish line. It's just better business.
Yeah. I would put a pin in that because that's a lot of people they've heard bad things about rent-own because of those buyers not being set up for success, not running the numbers for like exactly what you just said. And that could be a reason why the two big players in this industry are gone. They've both ducked out of the market. There might be other factors in there, but we hear stories. We're in the business and we do it the right way, doing good business, helping people. So,
yeah, absolutely. Right. If they don't have a vested interest in your success as a buyer, they're really just an asset manager and they're just collecting houses. Right. Yeah. And then they're hoping that people fail and then go do it again. That's not our approach. We don't want to collect houses, right? We just want to help bridge people. Now, so it's not done for free, obviously, right? It's not done for free. You're an agent, you get paid. I'm a lender, I get paid, right? But we're giving somebody an opportunity to get something that they can't get today, right? Another thing that came up in this conversation was, what is their payment, or is their payment going to be like market rents, right? So if somebody says, hey, I want that 3,000 or 2,000 square foot house, but the house next to it is being rented for, let's say, I don't know, $2,000. Is my payment going to be the same, right? Or is it going to be market rents? Well, those are two different things, right? So you could be a tenant, and that landlord isn't going to sell you that house, isn't agreeing to take your $2,000 a month and let you buy the house for a fixed price today, in a year or two, or when the time, they're not intending to sell it, right? They're intending to hold it for 30 years and put in the next tenant and the next tenant and the next tenant, right? So when we qualify you, we want to make sure that you can afford the payment that you're going to get when you go get your financing. Because if I give you $1,000 payment and your payment when you go get your financing is $3,000, it's going to be a problem, right? Because you probably couldn't afford it, or you don't have a history of making that kind of payment. So we try to match it up to what your payment would roughly look like. So that way, when you go get your financing, we have proof and documentation that you made that payment for a year or 2 or 3 and you can afford it. And we document that and we provide that to the lender and say, hey, they can afford it. They made the payment on time. It's well within their means, and it makes it easier for them to qualify.
Yep. Great point.
Any additional thoughts here before we wrap it up? We're going to try to keep this one short today.
Yeah, I got to take off here. So I think we covered the basics. If anybody has questions, heard rumors about how this all works, and they're tentative lenders or agents, we run into people in the business like we are that don't really understand it and want to make sure first that they can help clients that they normally couldn't, and both protect those clients and themselves, and know that they're going to get paid both as lenders and agents. So we could talk, that could be a whole other episode, but
yeah. And as you mentioned, right, sometimes we have to protect people from themselves and say, no, you can't afford that house. That's not the right house. Let's find you something that's more going to be in your price range or more affordable to based on what your income or what we verify or what you're telling me, right? We're trying to keep people out of trouble too, right? Because it's not good to be able to say, hey, well, too bad, so sad, and then you never could have qualified that, and then it's just bad business. But ultimately, what we're doing is we're helping people get today what they can't get, and so that's why they're willing to understand that their payment may be higher than the market rents because they're not being a tenant. If they want to be a tenant, they can continue being a tenant. And that may be an option. That's fine. You don't have to. Right? You may not be ready, right? You may not be ready, but this gives them the opportunity to get something and also participate on the upside of equity over the term of the program and into the future, which they're not getting from being renting, paying the market rents based on where the landlord down the street.
Yeah, we can definitely.
That equity goes to the landlord. It's not going to you.
Yeah.
So, all right. Well, I think that covers it for today. I think we covered, some of the important aspects. So if you're an agent or lender, want to have a conversation on how our program works, contact James. James, how can they get a hold of you?
Go to the link there, Linktree/partner with James Brown. I got a bunch of links on there. So.
Yeah. All right. And then if you want to get a hold of me, you can reach me on social media. You can go to our website. That's rent2own.homesus.com, or you can follow me on Instagram, TikTok, and YouTube at Mr. Rent-to-Own Homes. So until next time, we'll see you. Bye-bye.